Welcome to Geared for Growth. I'm your host, Mike Mortlock, Managing Director of MCG Quantity Surveyors. Today we're talking about the Australian residential property market and how you might be able to invest in the property market rather than individual investment properties. We're talking to co-founder and CEO of Longview Property, Evan Thornley, and he gives us some insights into some industry white papers that his business has produced and some of the structural problems that we have with property in Australia, issues with accessing money for a deposit to enter into housing, issues that we have with tenancies, inefficiencies with one-to-one ratios of landlords and tenants, as opposed to institutional investments, and of course the issue of diversification and how you could potentially be involved in investing in a diversified residential property fund, which typically doesn't exist in Australia compared to the commercial investment trust that you can invest in. So it's an awesome interview with Evan, who is a highly credentialed prop tech and innovation guru. He has a very extensive resume in starting a number of businesses, getting to the point of valuations in the multiple billions. So he's a very engaging speaker, got some really innovative ideas about the ways that we can reframe the investment in Australian housing and try and create some more balance and solving some of these affordability issues that we see today. An awesome interview with Evan. Here it is. Evan Thornley, thanks for joining me on Geared for Growth.
Terrific. Thanks for inviting me, Mike.
No, I've been following your work for quite a number of years and very interested to have you on the show. For people that maybe haven't come across yourself before, Evan, could you give us your brief bio?
Yes, well, I'm actually a recovering lawyer, if the truth be told, in terms of what I did at university. But I then went to McKinsey & Company as a management consulting career, but left that after 5 years and went to Silicon Valley. So I put the first Australian tech company on the NASDAQ. A company called LookSmart, which was an early pioneer in search-based advertising. Took it to 14 billion of market cap, which was real money in those days. Dual listed on NASDAQ and on the ASX, and then came home to Australia and have been involved. I'm a serial entrepreneur. This is my 14th startup, but not all of them have been businesses. Some of them have been public policy think tanks like Per Capita. Some of them have been social ventures. So Good Start is probably the one I'm most proud of. When ABC Learning went broke in the GFC, we thought, gee, it would be much better if Australia's early learning was run for the good of the kids. And so put a non-profit consortium together called Good Start, which now owns most of those ABC Learning centres and is indeed run for the good of the kids. But for the last 10 years, I've been focused on residential property and trying to work out how we can make investing in residential property more effective for people, because it is the biggest form of investment in this country and certainly the form of investment that has the largest number of people involved, much more so even than the share market. And the longer I've spent doing that, the more it's become clear to me that many, if not most people, are not particularly successful in their property investment journey and certainly could be more successful. And so we started Longview. We chose the name Longview because property is a long game.
Like that.
It's not for we're not into flipping and those sort of short-term transactional things. We're about creating long-term wealth and helping clients create long-term wealth. We started with the most basic thing, which was helping manage people's property better. We felt no one managed properties well. It was mainly real estate sales agents that were really just doing property management to feed their sales business. So we've tried to build a high-quality property management business. I think you could argue we're the top-rated property manager in the country now. I think we've won 11 state and national awards. We manage about 4,000 properties, mainly in Melbourne and Brisbane, but we will be going to Sydney shortly. But as we got good at that, and that took some years, it became clearer to us when we looked at the investment returns of our clients that actually a surprisingly large number of them were getting very poor returns. Particularly, we're getting poor capital growth. And Australia is, every property market's a trade-off between capital growth and rental yield. Mm-hmm. For better or worse, the Australian residential property market is close to the best capital growth market in the world, but that means it's got some of the worst rental yields in the world. Mm. And so the people that have generally been successful in Australian residential property have been principally successful because they've generated a lot of capital growth.
Yep.
And yet we looked at the average landlord that we dealt with, and they're a pretty representative sample of the wider landlord population, given how big our rent roll is. And they were getting on average 2.8% per annum lower capital growth than the housing market average.
Right.
And so we realised that they'd been systematically, in most cases, buying the wrong assets. Mm-hmm. And so no matter how good a job we did of managing those assets, if you haven't bought the right asset in the first place, you're ultimately not going to have a very successful property investment journey. Mm. So then we got involved in buying advisory, and some of the leading buyers advisors in the nation, some that Warwick Brooks, Scott McGeever, and others have joined us so that we can help clients buy well. But we also supported those sort of 20-year buying veterans with a data science team, which probably reflects my background at McKinsey and Silicon Valley. So our data science teams analysed every sale price of every individual property in Australia for the last 50 years, really trying to get to the bottom of what drives good capital growth. Mm. So we did that, and now we can help clients buy well, which is the most important thing. But we still realised from all of our work with our landlord clients that there were a lot of costs, taxes and hassles involved in being a landlord and a property investor, and some fundamental issues like an inability to diversify your investments. Obviously, you don't want all your eggs in one basket. You want to have access to liquidity. And so ultimately we concluded that a better solution, or an additional solution that people should have access to, which for some reason in this country we don't have access to, and there is in almost every other country in the world, is what I'd call housing funds. So being able to invest in a fund, just like you invest in a superannuation fund for your retirement, you should be able to invest in a housing fund as a way of investing in residential property, as an alternative or an addition to owning individual properties. And if we do that right, people should get better returns and less hassles. And that's what we've been working on for the last 4 years. And we've recently, we've been growing our first of those funds, called our Home Equity Fund, as a way of giving property investors an alternative way to invest in property. And that fund embodies everything we've learnt about what works and doesn't work in property investment.
It's interesting. If you want to invest in property, you've got a sea of property investment or real estate investment trusts, which typically will be looking at rather large commercial property assets. But up until maybe 10 years ago, when we started seeing some of these fractional investment models where I'm thinking of like the BrickX, there was really no way to invest in real estate unless you formed your own syndicate or you purchased with a partner or a friend. There was no way to actually have a piece of that. And you're right, when you think about property investing and you look at the RBA data that says what percentage of our actual wealth is housing, it's absolutely massive. And it's an asset that's so difficult to diversify, because let's say you've got $100,000 to invest and you're looking at a property in Melbourne and you're having to spend $800,000 or $900,000, then you really do have all of your eggs in one basket just by virtue of the asset price, right?
Oh, yes. And here in the People's Republic of Victoria, you're up for massive land tax and a range of other challenges that many of our landlords obviously face every day and that we deal with. I've got 100 people in this building who deal with these problems every day. And so, yes, I've spent 10 years trying to understand why on earth is there no investment grade fund in this asset class. There is in, as you say, every other property asset class. In commercial, in office, in retail, in data centres, in every type of property, and of course in every other, in shares, in bonds, in global equities, crypto. There's more crypto funds in this country than there are residential property investment funds, and that's weird because in every other country in the civilized world you can do that, and in this country you can't. So we've really tried to understand why the various efforts to create residential property investment funds have not got airborne, and we've engineered, I think, around all of those issues to try and deliver a really powerful alternative to investors. And, one of the issues you raise is just, ticket size, right? I mean, property in Australia, particularly in Sydney, Melbourne and Brisbane, is now so expensive that to get a good quality asset, I mean, if you look at the capital growth, relatively few properties under $1 million get average or better capital growth. And we can talk about why that is, right? So now you're talking about a very substantial ticket that can be beyond many people, and certainly beyond them to own more than one.
Yeah.
And particularly with interest rates as high as they are, if they have a little bit of equity and a lot of debt. And those valuable properties that get good capital growth tend to have more of the value in the land, and so the land tax tends to be higher. And so it's very challenging for people to really get a good property investment outcome that is diversified, that isn't killing them on cash flow, and that is accessing the right assets.
So give us a peek behind the curtain. Why was there no such thing really when it comes to investing in residential property through a fund? Was it a regulatory issue? Was it a legal issue? Like, why haven't we seen
we saw
more
four
of this?
barriers, and I tried to interview every suspect I could find who tried to put a resi property fund together in the last 20 years. I'd say there were four issues, and I think we've engineered around all of them. So the first is that people's instinct was to mirror what we see in either commercial property, where it's all yields and whales, or even the resi property funds overseas, like in the US, in the Sun Belt of the US, which are driven by rental yield. So, people have tried to put resi funds together driven by rental yield, and some of this build-to-rent stuff is still trying to play that play. I think that's really hard in a market where, gross rental yields are typically, 4 or 5% on a good day, and on the high capital growth properties, often less than 2%. So yield is generally not, in purpose-built student accommodation or NDIS housing, you can get good yields. But in general run-of-the-mill suburban property that gets strong capital growth, the yields are dreadful. So a fund that's seeking yield is fundamentally constrained in Australia. So you've firstly got to decide that your objective is to harvest capital growth as the principal wealth creation mechanism. And most people didn't do that. Secondly, there are people who come out of the big funds management world elsewhere, and they've sort of said, gee, if I can just get 200 million from Aussie Super, I'll have a decent sized fund and this will all work well. Well, the institutions may one day come into the housing funds, but they're never going to be the first investor. They'll be the last. So I think any new fund manager in a new asset class needs to start by getting a large number of smaller investors in and building their track record and building proof. So that's how we're building our business. Thirdly, particularly if you're investing in rental property, and you look at the big single-family home funds in the US, for example, I've talked to some of the biggest, and first question they ask me is, tell me about your field operations. Right, you've got to manage stuff. You've got to manage properties. Yeah. You can't just be some finance jock sitting in downtown or some tech bro sitting on a beanbag somewhere in the inner city. This is residential property we're talking about. Every home is different. Every home has issues. Every home has people living in it who deserve to be looked after. Yep. And so if you can't run things in reality in the bricks and mortar world in the field, then you can't be an investor in this asset class. And, we manage 4,000 properties. We know how hard that is.
Yeah.
And then the final issue for people is land tax.
Yes.
And, if you're chasing capital growth, land appreciates, buildings depreciate. The more of the value that's in the land, the higher your capital growth is likely to be, all other things being equal, depending on the location. But that also means the higher your land tax bill is going to be. And because of the progressive nature of land tax, if you own more land in one state, you pay a higher rate of tax. So you're actually disadvantaged. So we've tried to come up with solutions to all those four problems. And I think our home equity fund does that.
So I want to just rewind for a moment where you talked about harvesting capital growth. I'm interested in the fundamental issues of a model that, let's say the fund kicks off and you buy $10 million properties and they're all at a 1.9% yield, but they're growing at 5 or 6% per annum. Typically, the fund will be high yielding assets if it's commercial properties, and that way you can provide that return to the investor. But when you're building that capital growth, how are you actually giving back to the investor? I'm guessing that's where the harvesting comes in.
Well, that's why I use the word harvesting, and I talk about a self-harvesting portfolio. So, we're looking to, our first fund will have about 200 homes in it, okay? And so a certain proportion of those homes will get sold every year, and the capital growth will be harvested from that process. So that's
Right.
how you can deliver ongoing cash flow. The intriguing thing about our first fund, we will be launching a rental fund probably next year. But our first fund is not buying rental homes. It's actually co-investing with homeowners in their home, either helping people buy that home by contributing additional equity or giving them access to the equity they have in a home they already own. Either way, what we're doing is investing our equity, our investors' equity, in exchange for a share of the future capital growth in that home. And obviously, we only do that in homes where our data science and our buying advisors are confident we're going to get very strong capital growth.
For sure.
So that way, we can access a large number of quality family homes. I mean, the average value of the homes we're investing in at the moment is $1.8 million, right? These are quality family homes in Sydney, Melbourne, and Brisbane. We can invest in a large number of those with a smaller amount than you would need to buy all of those homes. So you can get much more diversification. And because of the nature of our contract with the home buyer or homeowner, we get a multiple of the capital growth. So our deal with the homeowner is we will give you really friendly money, equity, not debt. We're not a bank.
Yep.
You don't owe us interest. You don't pay us back every month. We can't throw you out of your home if you don't meet our requirements and all the things that banks do. But in exchange for that very friendly equity investment, we get a disproportionate share just of the future capital growth.
Yep. So
our typical deal with a homeowner or home buyer is we'll give you 10% of the value of the home, very friendly equity, in exchange for 1/3 of the future capital growth.
Yeah. Okay.
And so let's say it was $1 million property. We'd give $100,000 of equity, very friendly equity money to that home buyer or homeowner. They would give us a 1/3 share just of the future capital growth, not of the $1 million home, just of the future capital growth. But if that home doubles in value in 10 years, as a good quality family home would do, then that's a very substantial share. So our investors only make $1 if the homeowners made $2. So it's a win-win situation. But our investors then get a very strong return. So they get the equivalent of a levered return as if they borrowed money to get more power out of their equity. But there is no borrowing. So we have no debt. We have no interest payments. We have none of the risks or costs of debt, and yet we still have the leverage because we get a disproportionate share of future capital growth.
That makes perfect sense to me. And I know that you're a very driven problem solver. And of course, we do have a housing affordability crisis, or at least a rental affordability crisis at the moment. And I'm just kind of thinking, well, there's a front end and there's a back end problem that kind of solves. I mean, on the front end, we're talking about people that may not have had the deposit or the capital to buy at all, and you're solving that problem in the same way that we're seeing some state government shared equity schemes and incentives. Obviously, there's limited places, so it's good that there are private solutions that maybe have greater scope. On the other side of the equation, we hear so much about baby boomers or people that are asset rich and cash poor. We did see the onset of reverse mortgages, and I thought that's a hugely amazing innovation for the property market. I think the uptake has underwhelmed by a huge factor, because I suppose you get to that point, the idea of giving away part of that home is a bit of an issue. But we do have people sort of stuck in homes that don't have a certain amount of cash flow. The homes might not necessarily be fit for purpose for them as well. The household formation rate, I think if we add, one decimal point here or there, we're talking somewhere around 120,000 homes. Like it's amazing, actually. Are you looking at the problems within the housing market and designing solutions to solve where you see we're going wrong?
Look, absolutely. In this first fund and the client products, the Buying Boost and Home Flex products that we deploy the capital with, are the beginnings of that process. So, look, we published a series of white papers before we actually launched our first fund to explain what we were doing and why. And we did those jointly with PEXA, okay, the big electronic conveyancing giant, because, they have all the data. We wanted to publish very thoughtful, fact-driven, analytical papers. They're very readable. But if you look on our website or you Google Longview PEXA white papers, you'll see our explanation of what really drives Australian house prices and why purchase affordability is so difficult in this country. And it's not most of the topics that most of the public debate wastes its time on. Mm-hmm. The second one was what's wrong with the private rental market, both for renters but also for landlords. And in that, we showed that, the average return on capital for landlords in this country is about 6%. It's actually less than you would get in a balanced super fund. That doesn't mean some landlords aren't doing much better than that. But on average, their returns are actually surprisingly poor for the cost and risk and hassle that they are experiencing. And the third white paper then started talking about, well, what transformational changes would you make in the structure of the housing markets that would enable you to solve both the housing problems and the investment problems. And central to that was the idea that individual investors in individual properties for individual renters is a bad system for everybody. Mm-hmm. It delivers poor returns and lots of hassles to landlords, and it delivers an insecure and undignified experience to tenants. And it's in a world where people's ability to get out of tenancy and into home ownership is constrained by their lack of access to a deposit if they don't have the bank of mum and dad. So Longview's tried to think through systemically what you would need to do to transform that system, how you would create a series of housing funds where the property investors and landlords could invest in the fund rather than just the individual property or in addition to individual properties, and where those funds could then deploy that capital on more effective housing solutions, whether those are rental solutions or purchase and ownership solutions like shared equity.
Yep.
So I think we've got a holistic view of what the whole system needs to look at. We're trying to start implementing that piece by piece, and that's what our home equity fund is the first example of, so that it can fund our co-investments with clients through Buying Boost and Home Flex.
Awesome. I'm interested to get your 2 cents, and this is probably a whole nother episode, if not a series. But how did we get into the mess that we're in? And is there a strong enough argument to say that it is a mess? I mean, we do know that it's harder to buy a property today than it was a year before or 20 years before, certainly. We do know that rents have not outperformed inflation when we look at, say, a 25-year period, but of course, the rapid pace of change that we've seen over the last little while is what's caused that huge amount of pain. The politicians are talking about this is a supply issue and we want to build 1.2 million homes a year. We know that that's already over before it's begun. Well, I suppose it began 1 July, but it's not going to happen. It's great that the private sector are creating these solutions to it. But if you had your finger on the button of what can be done at a state and a federal level, what were some of the needles that you would be looking to move straight away? The Geared for Growth Property Investing podcast is presented by our business, MCG Quantity Surveyors. If you're an investor or a property professional looking to get the best tax depreciation deductions for yourself or your clients, please get in touch with us at mcgqs.com.au. It's our mission to help as many property investors as we can to maximise their claims and maximise their property education as well.
Look, honestly, I think the first mistake we make is trying to answer any question about a large pressing social problem with a sentence that begins with the words, the government order.
Yeah.
Right? The irony is the housing problem is actually too big for government, right? Which is why we have to have private sector solutions. The only pool of capital that is actually big enough to change the answer is, in fact, the capital invested by landlords now. Okay, just to put some markers around that, if housing affordability, purchase affordability is an issue, and it's a huge issue in this country, The capital growth on Australian residential property this year and every other year, just the capital growth, the speed with which house prices are rising, is equivalent to the entire federal government budget.
Yeah, right.
Lock, stock and barrel, right?
Yeah.
Actually, in the last 12 months, it was $800 million. The federal government budget's $680 billion.
Yep.
Right? That's $800 billion was 5 times the size of all the earnings of every company listed on the Australian Stock Exchange combined. So the scale of the challenge and the opportunity of capital growth in Australian residential property is so huge that you need to find systemic ways of solving that are principally going to be driven by private capital. When people talk about the government ought to do this, the government ought to do that, the government just spent 12 months and a ton of political capital getting a $10 billion Housing of Australia Future Fund through the Parliament. I'm sure it's perfectly good policy. $10 billion in an $11 trillion asset class is just an irrelevance, right? Matchsticks at a mountain, as Paul Keating would say.
Yeah,
right?
I like that one.
People talk about the superannuation funds need to be the answer. And for a whole range of reasons, they're not going to be. But even if you could convince the superannuation funds to put, say, 1% of their total portfolio into housing solutions, and no one's convinced them to do that yet, that'd be $38 or $39 billion in an $11 trillion asset class. The only pool of capital that is big enough to make a difference is the $2.2 trillion, the $2,200 billion that Australia's landlords have invested in residential property, even before their own homes, just in their investment properties. And so if you can create a housing fund industry that gives those landlords and property investors better returns and less hassle, and moves that capital out of individual ownership and into those housing funds, you've then got a pool of capital that can deliver housing solutions, both in rental and in owner-occupiership, that are dignified, secure solutions for the people that live in those homes. So that's really our recipe for what needs to be done, and that's what we're trying to build.
You know, that's a very eloquent response, and I've sort of had this argument with people before, because every year we hear the negative gearing losses claimed by property investors and the burden that it is on the budget. And if you look at the long-term average, we're probably talking around about $3.6 billion a year.
It's just irrelevant. I just don't get into the negative gearing debate. You can debate it. I've been in public life. I did a brief cameo as Premier Steve Brack's right hand. I've run public policy think tanks. I've been very involved in these public debates. I don't even bother taking a side in the negative gearing debate because, emotive as it is, it's just mathematically irrelevant. It is completely and utterly irrelevant. If Australian properties are going up $600 to $800 billion a year, and the value of negative gearing is some small single digit, or even the advocates of the biggest claim against negative gearing say it's $13 billion a year. Whatever it is 2 to 3 orders of magnitude away from being significant to the scale of the issues that we're dealing with. And yet, people have died on that hill and lost elections over it. We've been arguing over this issue for literally 30 years. And meantime, the real causes of the issue and the real solutions are not being dealt with.
Well, I suppose my argument is kind of centered on the fact that, okay, well, we've got a rental affordability crisis, and certainly that's an issue. I think we do need to deep dive into what exacerbated that problem and some of the external influence that has forced people to sell. And of course, you're sitting in Victoria right now, and we've seen a big landlord exodus. But, the government owns somewhere around 300,000 residential rental properties. If you were to replace the 91% that private owners own and supply to the rental pool, I think you said 2.2 billion. I worked it out to be 2.4 thereabouts. You say 3?
Sorry, 2.2 trillion.
Yeah, 2.2 trillion, I should say, yes.
Whatever it might be,
Yeah, so I worked it out at, I think if we looked at, say, 33% of all of the dwellings, it works out to be around that $2.4 trillion. And for 3.6 billion in negatively geared losses, I think that is the best deal the government is ever going to get. And the government doesn't have the budget to go and purchase $2.2 trillion worth of real estate back from mum and dad investors,
right? The entire federal government budget, lock, stock and barrel, was $680 billion last year. Right. So we've got to deal with the scale of the problem. Just one thing that most of the commentators get wrong about the supply issue. The supply of dwellings and the supply-demand balance for dwellings absolutely does impact the rental market. And look, we manage 4,000 rental properties. Clearly, rents have been going up substantially because there's been a shortage of dwellings. And so there needs to be a new additional supply of dwellings to mitigate that problem. No question about that. But people then say, well, that will solve the housing affordability problem in terms of purchase affordability. Mm-hmm. What most of the commentators, including a large number of economists who should know better, don't do is separate the supply and demand for land with the supply and demand for dwellings. Mm-hmm. What causes the purchase affordability problem in this country and what causes the massive capital growth from which many of us are now profiting is an imbalance in the supply and demand for land, principally well-located land in the suburbs of our major cities. And this is what we put in White Paper 1. When you have the second highest population growth rate in the developed world and have had since before any of us were born, and the highest level of urban concentration in the developed world, more than half of those people living in just 3 urban centres, and that proportion is still growing, then the value of well-located suburban land has doubled every 8 years for 100 years. Right? Yeah. That's what's the underlying driver. And I'm not an advocate for reducing immigration. I believe in a big Australia, and I believe in, and our entire economy is geared around it. But we have to accept that if that's the country we want to build, and we are building, and we have been for 100 years, the challenge and the opportunity with that is that well-located suburban land is going to keep going up in value, right? And so it's with that understanding that we guide our clients, both in their own purchases and in everything we do in the fund, to invest in what we call RODWells, robust older dwellings on well-located land, because land appreciates, buildings depreciate, where you've got a quality family home that's been there for a long time on a well-located block of land. 75 to 80%, sometimes more, of the value of that property is the value of the land underneath it. That's the proportion of your money that's going to go up in value. The proportion that's in the building typically will depreciate. And so that's how you buy the right assets. And most landlord investors get tricked into buying other assets either because they don't have the capability to pay for a quality family home that has a high land content, or they're tricked by discussions about depreciation or stamp duty benefits or negative gearing tax benefits, all of which are real, but all of which are typically an order of magnitude less important mathematically than the impact of strong capital growth. And so that's really where we've seen thousands and thousands of property investors and landlords disappointed, because they invest in property for 2 reasons. It's safe compared to, say, the share market, and they know from their own experience in their own family home that it often goes up in value quite a lot over a period of time. And if they bought more of their family homes, it would. But the irony from so many of our clients is almost every landlord client I have has made a stronger return on investment in the family home they bought for lifestyle reasons than in the investment property they thought they were buying to make money. And so that's because it's a better quality asset. The better quality assets have the better quality return. So if you want to invest in residential property, what you actually want to invest in is quality family homes, or what we call RODWells. And so we built our fund to give people access to the ability to invest in hundreds of quality family homes, and yet to be able to do that with as little as $100,000. So get exposure to the type of quality of assets that we ourselves often live in, the type of assets that have got decades and decades of long-term capital growth, and to do so diversified across hundreds of properties. And for reasons we talked about earlier, that opportunity hasn't been there before, but that's what we've tried to create for the last 4 years.
That's interesting. It's the first time I've seen a fund actively engaged in what many property investment advisors would call a blue chip residential asset.
Exactly. Yeah. Yep.
So I want to ask the question, and you've just answered that a moment ago, sort of the minimum investment amount, because we're used to these funds where a requirement is you need to be a sophisticated investor. You have to
Yes.
have 2 million or be on 250K a year or
Yeah.
or what have you. You mentioned that, for as little as 100K buy-in, and I suppose it begs the question that we've prefaced a little bit when we talked about diversification. If you have 100K, you could purchase a well-located Rodwell, as you say, and you've got, of course, the leverage of that, so you're getting a return there. Or you could be investing in a fund, and this huge advantage there is the diversification, right? You're not
Well, and
tied to the
honestly, with
performance of one.
100K these days, certainly in Sydney, Melbourne, or Brisbane, you'd struggle to invest in a quality asset,
Right.
Because most of the assets that get the best capital growth are in excess of $1.2 million.
Yep.
Because they have a lot of land.
True.
Content, a lot of land value. Don't confuse that with lots of physical land. It's the value of the land as a proportion of the property. So you can be a terrace house in Paddington in Sydney, or Albert Park in Melbourne. That's not a huge volume of land, but the value of the land is extraordinary. And
of course, yeah. So what would you say to people that are sort of toying with the idea of I'm actually looking for something to purchase? Let's say it may be in an area where the median house price is a little bit lower. Let's say it's in Adelaide or parts of regional New South Wales or Queensland. What would you say to people that are looking at something like that, as opposed to investing in a diversified residential fund?
Well, to me, it's all about risk, right? I mean, people invest in property principally because it's safe. They really don't like taking risk, right? Mm-hmm. They don't want to wake up one fine morning and find out someone farted in New York and they lost a third of their life savings, right? That's why they invest in property, not equities and other asset classes, and rightly so. And there is very few asset classes in the world that are less risky than Australian residential property. But having one property and one property only is inherently risky. You may buy the wrong one. You may not figure that out for 10 years when you find out you didn't get the capital growth you wanted. You may buy it in a location that is not going to perform well. You may end up just with some actual problems with the property itself or the tenants or whatever. You've got, to use a simple phrase, you've got all your eggs in one basket. And that's just not a good way to invest in anything, because you only need one thing to go wrong and something can go dramatically wrong. So it's inherently more attractive to be exposed to a wide diversification of assets than just one, all your eggs in one basket. And everyone I talk to, every landlord I talk to goes, yeah, well, that's kind of obvious. I mean, obviously, I would prefer to have exposure to a lot of properties, but I don't have that sort of money. I'm like, well, that's why we created the fund.
Yeah.
So, our funds are just getting going now, but we're currently invested in about 56 properties across Sydney, Melbourne, and Brisbane. So about $100 million worth of residential property.
Yep.
And people can get a share of that and the capital growth in those properties, because that's the way we invest, for as little as $100,000. As of right now, Mike, we are still only for wholesale investors, but we will likely be getting a retail license so everybody can put that money in. Look, my experience when I talk to my own landlords is about half of the landlord property investors I talk to are qualified to be wholesale, particularly when you include the value of their family home, or their incomes. So about half of them are legally allowed to invest in this fund. Many more could afford to at a minimum of 100,000, and we should be able to enable everybody to do so sometime in the first half of next year.
Yeah, beautiful. I want to pick up on a comment that you made a little while ago, and that was the inefficiency of the system of having, say, one landlord and one tenant. It does sort of seem like the government is leaning into these build-to-rent programs where it sort of seems like we're going to have companies as mass landlords rather than the one-to-one mum and dad investor. And it sort of begs the question from a tenancy point of view, is that actually a better outcome that I'm talking to a corporation rather than one property manager?
It can be better or worse. And so what I say to governments is, government's job is not to do this. I mean, I built a public policy think tank around this idea. The role of government is not to do all the work. It's to design a market where the market will deliver the right outcomes, not the wrong outcomes. Mm-hmm. It's like the job of the AFL Commission is to design a game of football that will deliver a good competition. Yep. It's not to put teams on the paddock, right? And if you write the right rules, you'll get a great competition. If you write the wrong rules, you'll get a rotten competition. So you can see some of the egregious corporate landlords in the US, for example, predatory landlords. That's an awful situation. And that's not the type of housing fund industry we want. But if you look at the institutional ownership of a lot of housing in Northern Europe, for example, you get dignified, secure rental. People get to build a lifetime, build a community, get to stay as long as they like, get to know their neighbours, get to keep their kids in the same school, get to have dignity and security, paint their daughter's bedroom any colour they like, So fund ownership or collective ownership of property can be good or bad. It depends how it's done. But the purpose of building a housing fund industry and the purpose of every fund that Longview is going to be building is to make sure that whether it's helping owner-occupiers or helping renters, it delivers dignified, secure housing, because that's the fundamental building block for any family.
Maslow has quite a bit to say about that. So, absolutely important.
One of the reasons Australia is the worst rental market in the Western world is not actually so much about the regulation, but the structure of the market. Tenants are moving every 20 months. Now, you're a single mum with 3 kids in the suburbs. That is just diabolical. And yet that system does not help landlords, right? It's just a bad system for everybody. And so a properly constructed housing fund industry, which can deliver significantly better returns to the investors at significantly lower risk because it's much more diversified and with much stronger cash flows, so a much better outcome for the landlord investors, and yet can deliver dignified, secure housing outcomes. So that's our vision of what we need to build. The key to that, the only way you can get that to work for both sides is to only invest in the right properties. Because that's you've got to have enough chocolates to go round. Yep. And that's why we actually trademarked this term Rodwell, but robust older dwellings on well-located land. But that's what our data science team and our professional buyers advisors are focused on, is ensuring that we buy the right properties. If we do that, we can deliver both for investors and for the people who live in the homes.
I love that, and I love the innovation in the space, and we certainly need to see much more of it. Evan, to finish us off, for the property investors that are listening to this show that might have just purchased their first one, or they're looking, or they're trying to expand in their portfolio, you've obviously got access to a big data science team. You've got access to some of the best and most highly credentialed buyers agents in Australia. What advice can you sort of disseminate from them that we can give to the property investors listening at home to really kind of supercharge their performance, or at least outdo the national growth averages?
Yeah, look, I go back to basics. I start with, don't believe what the property development or real estate sales industry are trying to sell you, right? They have their reasons. They have product they got to flog, and so they're trying to create a sales pitch that makes those assets attractive. There are virtually no new build high-rise apartments that have any decent capital growth at all, ever, right? They are a remarkably miserable asset class. And yet hundreds of millions of dollars are spent every year marketing and selling that product to unsuspecting mum and dad investors. So many of my clients have bought these, trying to do the right thing. Yes. Work hard, put some money aside, to make a lot of sacrifices often to create a legacy for a prosperous retirement or for future generations, and then they get tricked into buying the wrong assets. So, you have to start with, are you investing for capital growth or yield? You have to make some trade-offs there. There are obviously some properties and some markets where you can choose a middle ground, and for many people, they need to do that in order to have enough cash flow to pay the mortgage.
Yes.
But the most wealth is created through the high capital growth properties, and those properties are principally in the cities that have high population growth because the land values keep growing.
Yeah.
So ask yourself how much of your dollar of investment, how many cents in the dollar are effectively buying the land underneath the home, and how many are buying the building. And that doesn't just mean you buy detached houses, right? We've co-invested in, we're in an Art Deco apartment in Bondi in Sydney. There's only 4 on the block. The value of that block of land that the 4 are on is huge. You divide that by 4, that's effectively the amount of land that's generating wealth for the owner of one of those apartments. And actually 75 to 80% of the value of that apartment is actually the value of its share of the land underneath. So that's what's going to drive capital growth for people. And the question is how to get yourself exposure to as much of that land value with cash flow that you can afford to meet. And through some combination of how much you've got to borrow and how much rental yield you get. And obviously, we created a fund so that people didn't have to worry about cash flow.
Yeah, absolutely.
So they get pure exposure to capital growth on high land content properties and have no negative cash flows at all.
Beautiful.
So honestly, that's hard to beat.
With those basics and taking the long view, that's a little bit of a pun and a plug for you there, Evan.
Thank you. That's why we call it long view.
Yeah, often, you know, the most sagely advice is pretty simple, because at the end of the day, it's those simple fundamentals that make all of the difference. So thank you very much for sharing that wisdom today. And I'd love to check in with you in the future to see how that's going and see if we can get that to the retail investors as well. But thanks for sharing your insights and your wisdom today, Evan.
No, thanks very much for the conversation. Really enjoyed it.
Cheers.